So why do real estate investors use whole life insurance, specifically high cash value life insurance, to finance real estate? Why do they use it to purchase real estate and enhance their portfolio? The question is asked frequently because so many real estate investors use it. They have used it forever. Banks and corporations use cash value life insurance. There's something there. But the question we always receive, which is a fair question, is why? Why on earth would I use a life insurance policy to finance real estate, to build my wealth, increase my net worth? Well, it really begins with a life insurance policy. Cash value specifically here. What are some of the core benefits to a high cash value life insurance policy? Well, we've got some listed out here. Safe, liquid, tax-free, and then compounding. I'm going to explain what that means. So if I were to walk through each of these here, we've got safe first. Really what this means is when we take a whole life insurance policy, my money is in no way, shape, or form invested in the stock market. I have a guaranteed floor, often of 4%, and then a surplus on top of that gives me a total dividend rate. So safety, liquidity, I have access to the money really anytime I want. Very easy to get to the money within a cash value life insurance policy, whether I request this directly from the policy or if I use my cash value similar to that of a line of credit against real estate. So you're going to find as we go through this video a lot of real estate investors utilize or they resonate with cash value life insurance because it functions so similarly to that of real estate. Tax-free. Now this is something that is a huge draw to more than just real estate investors. So many people position boatloads of money in cash value life insurance because if you set it up properly, we use it properly over time, that cash value can be accessed tax-free. I can use the money tax-free indefinitely. Now I will add, there are instances that can occur that can trigger a taxable event, and we do make it a point to make everyone aware of that. We've got that in several other videos. Feel free to search our YouTube channel or reach out to us directly and we can send you some videos around what can actually trigger a taxable event on a cash value life insurance policy. Then the compounding. We're going to go through an example on this in this video as well, but a unique feature to a cash value life insurance policy is that once a dollar passes through the cash value of a life insurance policy, regardless if I let that dollar sit and grow and just accrue interest over time, or if I elect to borrow against it, if I take a loan against that policy, just like I would take a line of credit or a mortgage against a piece of real estate, I continue to receive appreciation on that same dollar as if I never pulled it in the first place. Another way to put it is that there is no lost opportunity cost. And you'll find how the insurance company does that. There is an interest component when I take a loan out. They also collateralize my death benefit. We'll provide more information in this video and then also the several case studies that will follow this as well. So why would I use a cash value life insurance policy to complement my real estate investments? Well, we just touched on some of the core benefits to a cash value life insurance policy. Let's progress on here. Often, real estate investors have a current strategy which involves typically one of these three scenarios. Maybe I'm using a bank or a lender. If I am purchasing real estate, whether it's rental properties, commercial real estate, residential, whatever it might be, it is very common to use a bank or lender and finance the property. That's the most common. Equity from a different property. Maybe I own a property free and clear or have a lot of available equity. So I say, okay, we've worked with a lot of real estate investors that do this frequently. They say, all right, rather than use cash or finance directly from a bank, let me borrow against my property and purchase another property over here. Can make sense, depends on the situation. And then the last option is cash. Cash, if I got the cash, do I just pay for it in cash? Does it make sense? From a financial standpoint, a lot of times it does, sometimes it doesn't. Here's my big thing though with cash, because often an individual who has the means to purchase property outright just through a cash payment is typically well-to-do. They're in a good position. And we have heard many times, just in working with individuals, whether they're real estate investors, business owners, that they don't care what the return is. Meaning, if they can hold on to their cash, leverage a mortgage at 3% to finance the property and have the property they purchase produce 12% in income if it's a rental property, whatever it might be, yeah, you could do the math there and say, hey, leverage other people's money makes sense all day long. And a lot of people do that we work with. And we work with individuals that can help you enhance those strategies as well. But with that said, so many people look at it and say, okay, I don't care what the return is because this gives me peace of mind. I want no debt on my balance sheet, so I'm going to purchase it with cash. And I agree with that. You know, I don't care if I'm earning a 100% return. If I have peace of mind with a particular strategy that I'm executing, you know, if I sleep at night, that's the way to go. But often, these are the current strategies we see. So, when it comes to the cash value life insurance policy, this can work beautifully with real estate. We're going to get into the details here, but there are some critical details I need to be aware of with the actual cash value life insurance policy. The reason why is we've seen many times, you know, at seminars I'm presenting at or talking to individuals one-on-one where they were presented cash value life insurance in the past. I remember one guy, he was proposed a policy of putting in $100,000 per year, but he looked at it and said, okay, you know, I've got 60 to 70,000 of the 100K I paid in right off the bat, but it takes me 7 years to get my money back, to break even. Specifically, what that means is by year 7, he's paid in a total of $700,000 and he has $700,000. That's the break-even point, or when he is cash on cash. He was not comfortable with that. He stated, hey, I can do better with my money elsewhere. Well, we showed him several different options. We didn't show him that 7-year break-even option. We showed him several different options that gave him close to 90% available equity right off the bat, breaking even very early on between years 3 and 5, and he had more money long term. So when it comes to the actual life insurance policy, life insurance policy, some things to be aware of here. The word capitalized, the capitalization phase. This is important, meaning when I pay money into a policy, how do I capitalize it where I actually see equity there, call it cash value, that I can access, whether it's in the first year, whether it's 5 or 10 years down the road, whenever it might be, whatever I have in cash, that is an asset to me. I have access to those funds. The policy must be properly designed. Now, really what this means, and we talk about this frequently when we design a policy, we've got the different components, right? Money can go toward my premium or toward my PUA rider. And really, to give you the short version, what we will teach individuals to do is copy exactly what banks and corporations do with these policies, which often involves squeezing the premium down to the absolute minimum so they have more available cash value. That's what they are after. And I get it 100% because it gives them more money. So it means reducing the premium. I'll refer to this often, call it an English translation, as the insurance expense. And then the PUA component stands for paid up additions rider. We'll call a cash dump in. Okay. So we'll spend a lot of time educating individuals on that policy design. And the main reason why is once you get that piece there and you know how to actually cash flow policy. When I say cash flow policy, not just allocate cash flow towards a life insurance policy, but towards the two areas, minimizing expenses, optimizing the cash value, which also gives us more death benefit long term when you look at a policy, that puts us in a great position. Then we've got flexibility here. Also, I'm sorry, to close up this piece. If this is set up properly, that policy design, we are in a position where regardless if we use the money or not, we've got the most cash value possible. Now, flexibility, this one is huge, and here's why. It ties into the policy design area, but when we design a policy, if I am looking to purchase real estate and I'm attracted to this idea of a cash value life insurance policy, would you want a policy where you are locked into or committed to paying premiums for the rest of your life, whether it's a high number, low number, whatever it might be? Usually no. For example, let's say I wanted to pay in $100,000 per year. Let's say you love all the benefits. I want the ability to put in $100,000 per year into a policy. But with my real estate portfolio and investments, if I commit to that $100,000, that may be a burden to me. I don't want to commit to it because then I get this bill. If I can't swing it, I'm stressed out. That peace of mind factor we talked about earlier is out the window. We don't want that. So you can easily design a policy. So this has to do with flexibility and properly designing it. You can design it in a manner where I commit to a minimum premium, depends on my age to be specific, but we can get it very close, to call it $10,000 per year. That means literally I can commit to $10,000 per year and then have the ability to add more funds into PUAs at my leisure. Now all of a sudden, I've turned a insurance policy where I think bill, premium, same amount every month, every year, into a flexible savings asset. Now I can be creative with it from the funding standpoint. I do the exact same thing. This way I can commit to an amount that does not hurt my cash flow, never stresses me out, and then have the ability to dump money into PUAs, accelerating my cash value at my discretion, depending on how the business produces, good months, bad months, all that fun stuff. Again, I don't want a burden or this big fat bill. Let me commit to an amount that's reasonable, and then I can add more funds in at my discretion. The funding period. You hear the word whole life insurance. How long naturally do you feel like you have to pay into the policy? Your whole life. So if I'm investing in real estate, do I want to be committed to a premium where I have to pay into it for my whole life? No, not at all. Well, the thing is, we do not have to pay premiums for our whole life. In our case studies, you're going to see examples where you can fund a policy for a very, very short period of time. Maybe it's only 5 years, but I might want to keep paying into it if things are going well, I'm liking the way that it performs. I often do not have to decide on that up front. We can design a policy to be very flexible on the funding, or the flexibility, the amount I add, and then also the funding period. If I want to pay in for a short period of time or a very long period of time. And then the loan interest. We're going to go into more information on that, but clarity around that piece, specifically around where it goes. There's a confusion out there often where individuals feel that they are paying loan interest to themselves when we take a policy loan. No, loan interest goes to the insurance company. And there's also ways to leverage a cash value life insurance policy. If I'm a real estate investor, I'm used to leveraging real estate often. So I can leverage a policy in the same manner to obtain an extremely favorable interest rate. Let's demonstrate here. So let's assume we've got a policy paying a dividend of 5%, which is conservative. And we've got a basic example here. We're going to assume we have cash value of $100,000. That's what's in our policy, whether we built it up over a long period of time or a short period of time. $100,000, that's my cash value. If I'm earning a 5% dividend, that 5% dividend is paid on my $100,000. I borrow out half of my equity. So I take out $50,000. I've got $50,000 remaining in equity, cash value call it, and then I have a $50,000 loan outstanding. What will happen here is in respect to that dividend of 5%, that is still paid on the full $100,000 as if I never touched it in the first place. Another way to put it is that there is no lost opportunity cost. My money continues to appreciate. If you owned a piece of property and the appraisal value appreciated by 5% every single year, if you own it free and clear, or if you take a mortgage out against it, if it appreciates by 5%, the entire asset appreciates by 5%. Does not matter if I have a loan outstanding or not. So, loans do not impact the appreciation on a cash value life insurance policy. Here's something I want to touch on here. So, When it comes to the loan interest, if I were to borrow against a life insurance policy, depending on the insurance company, on the actual carrier, I'm going to see rates typically range between about 5 and 6%. Loan interest accrues at annual simple interest. We've got several videos that can provide more transparency around how that works, but typically the loan interest is 5 to 6% with the insurance carrier. An objection we'll often hear, which is a fair one, it goes through my mind as well, is, hey, I can borrow from my policy, directly from a cash value life insurance policy, and it's extremely convenient. I pay it back when I want, if I want, it's completely in my control. It's great. That's why people like leveraging their cash value policies. However, if I have a 5% rate, say it's a 6% rate, that's high considering what I can get out in the marketplace today. I can get a mortgage or a line of credit, sometimes around 3.5%, sometimes much lower than that. So, with that said, we mentioned earlier that we can use a cash value life insurance policy, the cash value in a contract, in a policy, as collateral. I can go to a bank or third-party lender. Some lenders specialize in cash value collateral loans, and they don't require what banks do. No credit checks, financial documentation. They understand the whole life insurance product. They have a collateral assignment, which just, if I have a collateral assignment on my policy, it prevents me from draining the cash value or pulling anything out until that lender signs off stating, okay, you can pull money out, because they've given me a loan and they want to make sure that if I default on their loan, the cash value is the collateral there. Now, how this works is very similar to that of a line of credit. Meaning, if I were to take a line of credit, a HELOC, for example, what could I get, or what would I see in terms of an interest rate? Would it be 6%? Depends on my situation, but usually no, it'll be much lower. These loans, we can often find somewhere between 3 and a little over 4%. Very, very attractive. Also, if we're using it for real estate or a business purpose, often the lender will have on their applications, their paperwork is asking the question, is this loan for business purposes? If it is, guess what? I've got a potential tax deduction. So really, what this does for me is if I'm earning a 5% dividend and I can pay 5 to 6% to the insurance company or 3% to an outside lender while I yield the same 5% no matter what I do, and this can be tax deductible, well, hey, that makes a lot of sense. Now, what are the drawbacks, right? Always pros and cons, and we always look at everything, is if I take a loan directly from the insurance carrier, extremely convenient. I don't get monthly interest payments due, it can't be called, nothing like that. Very, very convenient. Convenience is key. With a collateral loan, typically I'm liable to pay the interest only, and there are going to be terms with the loan. The lender can call it, maybe I have to review it after 5 years, whatever it might be. Regardless though, my full $100,000 or whatever my cash value is will continue to stay at work for me. So if I had $100,000 and in the 10th year or 10 years from that point in time, if my cash value was going to grow to $300,000 or whatever the dollar figure is, that would be the case regardless if I just let it sit and grow or if I decided to take a loan out and then pay it back, which I'm not required to with a direct policy loan, but to see that full 300, I would have to do that. So using the two together, cash value life insurance with real estate. I can use a cash value life insurance policy. I should say the cash value within the contract that I've built up to literally purchase property. A lot of investors we work with do this. They love the peace of mind factor. They're really using this as an alternative to having funds sitting in cash in their bank account. One, this actually produces interest. You'll see the net internal rate of return typically yields somewhere between 3.5% to 5.5%. Depends on the company, historical performance, all that good stuff. But I've got that, you call it 3 to 5% net internal rate of return, tax-free yield, always compounding for me, instead of having money sit in a bank account, using it to then purchase property. Now, how I purchase the property can be in full or it's partial. A lot of younger guys we work with, when they're getting things going, trying to start out, they might not have the means, or we don't have to be young, we might not have the means at any point in time to purchase a $500,000 piece of property. Maybe it's a $100,000 piece of property. But I've got enough in my cash value to make a down payment with and begin to get comfortable with the policy. And then of course measure the numbers to see, okay, if it's a partial finance, meaning I'm partially using my policy and partially financing through a lender, what's the interest payments actually look like as I'm repaying that loan? Good to be aware of that stuff. Typically what we'll see is as we acquire more real estate, we're using the real estate income to then repay the policy loan. Whether that is rental income, whether it's a flip, I sell the property at some point down the road, whatever it might be, we can use our business, i.e. real estate, to then pay off the policy loan. Of course, the policy produces a rate of return. That's typically our number one money maker. Real estate investors we work with, quick side note here, their money maker is not the cash value life insurance policy. Convenience and guarantees. This is the reason right here. We're going to go through several case studies and models so you can see some actual numbers here, but this is it. Convenience is key, meaning why a lot of real estate investors, and myself included, do not like working with banks is it is a pain. Right? You go to take out a mortgage or purchase a home, you got to give them all the documentation in the world, bank statements, P&L sometimes depending on your situation, business tax returns, personal tax returns, W-2s. It's a lot of back and forth. And then they ask for it again when you're about to finally close on the property. So you do not have that with a cash value life insurance policy. With a lot of cash value collateral loans, depending on the lender, but there's some out there that exist, you don't have to deal with that either. So convenience is key. That saves me time and allows me to continue to push forward and grow my real estate portfolio, which allows me to then grow my policy further as well. And then guarantees. You know, we talked about very, very briefly with real estate. If I have a piece of property appreciating at 5% every single year like clockwork, if I own that home free and clear, or if I have a mortgage outstanding against it, in either of those scenarios, is the 5% appreciation on the appraisal value ever impacted? No. It doesn't matter if I own it free and clear or not. If it's guaranteed to go up by 5%, it's guaranteed to go up by 5%. The thing is, we don't have that with real estate. Now, life insurance does not guarantee that will increase by 5%, but we do have a guarantee. You'll often see the contractual guarantee is 4% on whole life policies. Now, quick side note before we start saying, oh, that's so great, that is a gross 4%, meaning credited after the insurance expenses and mortality charges. We've got some videos that go into the average returns or what am I actually earning on a cash value life insurance policy to provide more transparency there. But to get back to the good part, we do have a contractual guarantee, and what you will find with a whole life policy is over time goes nowhere but up. And I've got that tax-free benefit. So here, no matter what happens, my cash, right, my cash on hand will continue to increase. I can use it as a means to acquire more real estate, pay down existing loans on real estate if I don't want a mortgage or line of credit through a bank anymore. I've got that. Oh, and I've got a death benefit too, which is always paid out 100% income tax-free, which if I'm in a position, a lot of real estate investors value this kind of on the back end, and they don't realize it until after the fact. If they've got a portfolio, maybe they've got $3 million outstanding in loans, which we've seen cases like that, sometimes more, and they say, okay, I like the idea of this cash value life insurance asset, but if I've got a death benefit of 3 million plus, or say it's 5 million plus, that allows me to pay off all of the debts. If anything happened to me, I should say my family pays off all the debts. They own the property free and clear. And if they don't want the property, if they say, hey, I can't manage this stuff, well, they can sell it, and then they retain the income tax-free death benefit proceeds. They just receive a clean check. very easy in that respect. So a lot of ways you can leverage it. I know I'm going a mile a minute throwing information out there. Several case studies coming up next. I'm sure you will enjoy. A couple preview here. So not all at once. We've got 5 case studies we're going to see. Here's a quick sample. Different ages, 35, age 50, and age 60, different funding periods. But as always, I hope that this helps. Reach out with any questions, and we hope to talk to you soon. Thank you so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.